Well, good day, all. Ira Epstein, and here we are with your financial market wrap-up. And this wrap-up is for the evening, and we are now on Monday, the 12th of September, 2022. I think it's around 6:10 p.m. I didn't look at the time when I started shooting. It should be. I can correct it when we look at the first chart because it'll have it on there. So what do we have right here? I think that becomes the important thing that we all talk about. We have the CPI number tomorrow, PPI on Wednesday, but it's the CPI that everybody's looking at. Let me give you the numbers so that you know. In July, we had a reading of 8.5% for the headline CPI. That includes the whole basket as to how they measure. The market is looking, the consensus is 8 to 8.1%, a decline of 4 to 5/10. On the core CPI, which excludes food and energy, the July reading was 5.9%. They're looking for an increase of between 2 and 3/10 to 6.1 to 6.2%. The market is taking that the consensus decline, if it comes in, means the Fed doesn't have to go as aggressive as they've been being and as aggressive as some think, and we've gotten a phenomenal rally back in the stock market. Okay, is it warranted? I don't think so, but I don't know. Energy prices coming alive again. Why not? The dollar took a beating today, down 68 points. By the way, that's a bounce off the low of 50 points, and that kicked everything to the upside. Bonds and notes, I can't imagine professional traders want much of a neutral, more than a neutral position in that going into the report. In the grain market today, we saw that we lost a lot of acres, more than we thought. In the soybean market, and I'm talking amounts lost and not planted, we lost similar amounts in the corn, but the acreage number in beans fell a bushel an acre. It doesn't sound like a lot. It is a lot. And it set the market up nearly 73 to 75 cents a bushel. That's a big amount in one day. And the reason is it guarantees you're going to keep a tight market if the harvest comes in as expected. Now, you can get two things with that. You can get a worse than we think numbers. That'll be even tighter market, or slightly better. You don't know. You have to trade what you have. And the market was surprised to see the soybean numbers stay this tight. That's very, very important. We also saw that world stock supplies aren't dropping that much. Keeps the market worldwide pretty tight. When we come to the S&P, and by the way, the time is 6:12 right now. How do I know it? Because as I'm recording, that's your time, 6:12 p.m. The market fighting its battle on a weekly chart against the 18-week moving average of closes. We talked about that over the weekend. As you can see, you have a market that came down hard and is getting an equal rally. This has not been an easy market. This was easy. Coming up, going sideways, coming up, going sideways, going up. Up, coming down, going sideways, coming down. But the straight up move again, that's a vertical price rise, a bit more difficult to trade going into a major report. Is there a chart pattern? Well, there isn't, but there's one to study here. So let me give it to you. You know that we had on the, the 26th or so, Jackson Hole, where Fed Chair Powell gave a speech where he's very aggressive on fighting inflation. He's not going to give up. I believe he's that man, by the way. We have lower highs, lower lows. If you take out 40.19 and a quarter, I couldn't see the 4 there, 40.19 and a quarter, you break that pattern. You haven't broken it, you break it. Logic tells me that the market probably wants to run back to the 18-day average of closes, what I call that line in the sand, the red line on the chart. It's what I teach in my charting course. So here's where you're at. Here's the moving averages. You ran back to it and you stayed over it today. It was under it most of the day and you're trying to extend a little bit further. And this is where the next resistance point is if there's a big bullish report tomorrow. Yes, you can carry to 42.63 to 42.79, the combination of the 200-day average and the Bollinger Band. Do I think that's going to happen? No. Could it happen? Of course. What do I think is more likely? I think disappointment. The market falls back into these moving averages. Why? Well, just because that's how charts like to work. Momentum is up. You've had a vertical price rise. Am I telling traders to be in and out of the market that pay me to do so in my paid subscriber video? I told them to be in the cash. We will come in after the fact. This is too big of a report. This is as big a report as an FOMC report when we're wondering what is the Fed going to do. Because traders are looking to see if there's a trend. Inflation, it's on its way down. It's on its way down. There's no stickiness. That core inflation, it's not going to stay up there. It's coming down too. That's what they're hoping to see. Anything less than that's a disappointment. Anything greater than that, I'm talking 7.5% headline number, drop from 5.9 to 5.7, 5.6 in the core. How could it not be friendly? It will be, and you got to change your thinking. Do I want to be in a position where I get hurt by that? No, it's cheap for me to say this now, but at the same time, all my paid subscribers know that I told them, and I said, hey, we'll start trading again tomorrow after we see everything. Look at the Dow. Where did it go to? Same thing. You lost the embedded reading. You came up right to the resistance point. Are you trending? No. Once you took out this high, right here, 3 days ago, boom. That was the end of the downtrend. What about Russell? Oh, same identical thing. Look where you went, fighting that 18-day average. Now, when we come over to the VIX cash, which is loading up right here, it fell the opposite. Remember, if VIX goes down, stocks go up normally. I mean, you can have days where they're going the same direction. It's not common. So this market fell back, and its battleground is the 18-day average, that line in the sand. I will let somebody else want to trade that. Then we get to the 30-year bonds. You still have an embedded reading that's bearish. This market, everything on the chart says lower. If this keeps going down, why is the stock market going up? It means interest rates are still going to go higher. That doesn't mean that I'd want to be in this into the CPI report. I am telling you, I had people in TLT today short. Nice day. Said, just take your money. Why play around with this? All you can do is get hurt. Same thing in the 10-year notes. The trend is locked in bearish. You need a big surprise, and then the 18-day average in both this and in the 30-year bond, that's what comes into play. Now, before I go any further here, because I know you're going to want to know about the Russell and some of the other stuff here. This Thursday at 12:30 p.m. Central Time, I'm holding my first webinar since the summer. It's live. It lasts 20 minutes. Again, 12:30 p.m. Central Time. You need a user ID and password to come in. I've sent invites out to everybody on my mailing list. A lot of people have already registered. There's limited seating. It is free. If you don't get the email because you're not on my mailing list, there's a way that you can sign up. I'll show it to you right at the end of this video. Okay, this is out of sequence, but here's the Russell. So what the Russell did today as well, where did the Russell go up and fight its battle? Right at the 18-day average after losing the embedded reading. Now let me just show this part because I think it is so darn important. When you lose an embedded reading, any reading when you're embedded, both the red and the blue are under 20 and you get a settlement over 21, it is typically a sign the market is going to run to the nearest main moving average it hasn't hit. You already hit this on Friday. That opens the door up for now getting to the 18-day average of closes. Do you understand that? Here's the market coming up Friday. This was Thursday that you lost the reading. This is Friday. You still didn't hit it. That's the enhanced Bollinger Band course that I show you. And one person write me, it wasn't what he thought it was. Wacko. I mean, this is pretty important stuff. Lower low, higher high. I've never seen anyone do this, okay? I mean, this thing is super interesting. Run your own studies with it once you take the course. You tell me what you found out, okay? I already know. Then we look at the VIX cash. All you did is fall back to the neutral number, the 18-day average. That's your battleground. So again, I will let you people be the heroes of the market. I'm just a chartist. It's a major report. I have a philosophy. I don't stand on that train track trying to dodge that bullet train coming after me and say I'm going to be able to jump right, left, or right. You know why? The guys with the algorithms that are ahead of me on anything I do on the internet, they're going to be there, and whatever I thought I had in place to protect myself is useless. The market's gone on me. You'll say, well, I have a stop order in. They run it. I don't know what else to tell you. You'll see your fills come off. Most times, if the report just sort of neutralish, not a big surprise, stops get hit, they get filled in very good numbers. But I have seen craziness happen. I don't want to do it. I've been around this game too many years, 5 decades, seen it. There's going to be another opportunity. Right after the CPI, I got an FOMC, and then I have nothing for a long time. I get to trade the way I want to without the surprises at nighttime coming out or early in the morning and blowing up the chart. That's what I want to trade. I want to trade the chart action, not the event. Did you hear what I just said? Not the event. The event is where you get in trouble. The chart action, you got a shot at. The event changes the chart. When you look at the 30-year bond, still falling down, coming down, 10-year notes, same thing. And so now we go to the dollar index. Okay, all the dollar did is it lost its bullish embedded reading back here, and now it's down to the 18-day average of closes, which tells me the euro should go up to the Bollinger Band. It's 40% weighting. It's exactly what it did. Is this telling me to do anything with a lower low and a higher high, and I should buy into the Bollinger Band? Sure, you'll get me to do that or tell my clients to. Not going to happen. Now we get to the British pound. So you rallied right up to what number when you lost the embedded reading? We all know what's going on. We saw the European Central Bank come in. When they came in, you lost the embedded reading. Unless you get it back instantly the next day. What's the odds? The odds are you're going to the closest main moving average. Bingo. You did that. Game now neutral. It's that simple. Still in a downtrend, but neutral going into the report tomorrow. Bitcoin, once you lost the embedded reading, game was over. I think you might get up to the upper Bollinger Band if tomorrow's a big up day in stocks. If stocks get hit because of CPI, this market gets hit too. They seem to be joined right now. It's a risk-on environment that makes this work and a risk-off that breaks the market. That seems to be what you're at in this particular Bitcoin. Then we get to what's going on into the energy markets. And the market is certainly looking at the dollar. What is crude oil priced at around the world? Dollars. So as the dollars come off the 110.30 area into the 108 zone, that has made this less expensive. And you're seeing that you've had your rallies. But what have you rallied to? Off the Bollinger Band into the resistance of the 18-day average, off the Bollinger Band, just shy of that 18-day average, just cents away from it. Maybe you can get to it there. You never did embed, just got oversold, by the way, in the gasoline. And in that gas, market is respecting the bottom area of the 100-day average and the lower Bollinger Band. I've been telling my traders in my writings that I thought this market was bottoming here. I think this is an important bottom that is shaping up for the near term as we get ready to go into the cooler months here. I realize Ukraine has done great, and people are saying, well, that's the end of the war. Do you think Russia, even though they lost 1,100 miles on this swath, are through? They're not through, okay? This thing doesn't end this way. It doesn't end because there's been gains by Ukraine that suddenly there's plenty of natural gas. They're going to turn it back on in Europe, blah, blah, blah. Doesn't work that way. I mean, if you want to think that, it's a wonderful thing, and we all want that to happen. But it's not going to happen that way, not in any shape, way, or form. Now, what is going to happen is at 12:30 p.m., God willing, and I'm still here, we are going to have the live webinar. Now, it's 12:30 p.m. Thursday, the 15th of September, Central Time. In it, we'll talk chart analysis, market fundamentals, what the market's looking at. You can join via your desktop, a table, whatever. It's Zoom meeting. You have to have a user ID and password. It is fast-paced. So when you sign up, My email address is in your receipt with your user ID link and everything else. Write me what you want me to cover. Please don't do it during the meeting. If you do it on anything but futures, it's a pain in the neck for me. Why? There's thousands of stocks. I don't know all the individual symbols, but I've got all the major futures already in my charting software. I can just flip those. I cannot do that in each of the stocks. Give me the stocks you want me to cover. The ETFs, the spiders. I can do that. I'll set the charts up ahead of time, and I'll get to your question like that first. I will give preference to the written questions first. Does that make sense to everybody? I hope it does. So, to get there, all you got to do is follow this link right up at the top. Move your cursor. Get right up there if you're on a PC of any type. You'll see the link show. Give it a click. Sign up. You'll get your email. Write me the question, and I'll see you all for sure. Thursday, 12:30 p.m. Central Time. Have a great night.